Reversal signal providers, many of which claim 80% accuracy or better, will tell you that you have to have a 3-day window that applies, and yet will cluster together reversals. And I want to take a couple of minutes and show you what that means for a trader and how that the reality of what you're dealing with and whether or not their claims are realistic. Before you now is the Canadian dollar on the daily time frame, and I'm using this which covers a period between the end of October 2006 to the beginning of December 2006, because these dots that you see are dots that have been posted on a public forum by one such service provider. The signals that he calls and reversals. Now remember that the dots are not actually forecasted. It's the date that was forecasted, not whether it would be a high or low necessarily. And as you can see, some of these, you end up with 2 highs or you end up with 3 lows, etc. But if you look at it initially, well, yeah, you have a zigzag pattern here, and you move back and forth, and one could initially look at that and say, well, this looks pretty good. They call these reversals, so the service has some merit. Well, what is the reality? When you examine it a little closer, what do you find? One of the things that are required under these service providers is a 3-day window. Now, if you don't know what that is, basically that boils down to this. They provide a date for the reversal, and the reversal could occur on the day before or day after. So it's really a 3-day window the reversals is expected. Now, that doesn't seem too bad here. We have a nice low, and we go up to a nice swing. But let's take a look at what happens when you cover the entire chart and what you really see as the end result. Here's the next reversal, and here's the day before and day after that 3-day window. Now, what's not covered is this one day. So we are going to take this and we're going to mark it in red so that it stands out. And then we're going to go to the next reversal. That's this one, the day before and the day after. And here we have another one that has no coverage from the reversals, our reversal windows, and we're going to mark it in red. Here we have a reversal. The day before it's already covered, so we have the day after. Here's the next reversal, day before, day after. The next reversal, day before, day after. The next reversal, day before, day after. Now we have a day that's not covered, so again we are going to mark that in red. And then we have the next reversal, day before, day after. Next reversal, day before, day after. Next reversal, day before, day after. Now the fact is that this is about or almost a month and a half worth of trading. Now out of this, how many days are not covered by reversal signals? 1, 2, 3. 3. Okay. I think I could claim 80% accuracy if I'm marking 80% of the bars. Don't you? There's something really wrong with this picture, isn't there? And when you look at that from the reality, the 3-day window, and the fact that so many reversals are clustered together, well, what do you come up with? It's a pretty obvious conclusion that this is not what it appears to be. The claims are not as made. But you may say, well, I still like the service. I still like the idea of having the ability to determine a reversal. I mean, what else am I going to do? Well, there are reversal methods that provide the actual day without a 3-day window, but I'm not going to tell you anything about those things. All I'm going to do is show you a very simple tool that gives you basically what you are seeing from the service providers. This is a tool that's called a cycle tool, and I'm going to mark it for 4 bars separation between the two, because some of these are just no more than 2 or 3 bars apart. So you're getting a little bit broader stretch than some of these reversals. But I'm going to just mark it with 4 bars. Now, I want you to take note of what you end up with. Here's the low, of course, that we started with. And look, we have the exact same high. Look here, exact same low. Now, this one is not exactly, it's in between these two. But to be honest with you, I think I would prefer the one signal from here to here. And this one's a pretty good bar to short off of, to take for this market to drop in, rather than the confusion that comes from 2 signals. You come down here and guess what? Exact same reversal. Same thing here. Now we skipped this one, but hey, again, I would rather have this signal to this signal than deal with this one that's going to create some confusion. and then again back down here to this signal, which is, that's pretty good as far as the low is concerned. And so when you look at it, particularly with a 3-day window involved, what's the difference in what you're getting? Now you might say, well, that may be true, but what about the fact that it provides signals for the weekly or large time frames? Well, fine, let's do that. Let's look at that. Here's the weekly chart. Let's take a signal and apply it here. We'll do the same thing, a 4-bar distance, and what do we end up with? Well, we end up with, oh, look at this high up here. Oh, look at this high up here, beautiful. How about this low? This low, this high area. You can go down the list, this high area, this low area, look at this high. Beautiful. And you've accomplished the same thing. So when you look at the facts and what's being done, particularly in regard to a 3-day window, and on top of that a clustering of reversals, the reality is quite different than it's made to appear. And of course, I know you're intelligent enough to figure this out. It becomes pretty obvious what's happening here. If you cover 80% of the bars, well, it's hard not to have 80% accuracy. Wouldn't you agree? But you make your own conclusions, and thank you for viewing the video.